Hello traders, Steve Ganz here, and I want to talk about the Avgo long call that I hedged not too long ago. So Avgo had an earnings announcement and it rocketed up. And my expectation was that after it treaded sideways here a little bit, that it probably wasn't going to go much higher. So I wanted to hedge this trade. So if we take a look at the trade itself, the long call, and this started off as a single long call, then they had a 10-for-1 split. So it ended up being 10 long calls. And I was up at one point about $107,000 in that position. Now, I felt like that was kind of a blow-off top when we got to this point up here. And so I wanted to hedge the position against a pullback. So I ended up that I sold 40 call spreads against my 10 long calls. And what that looked like, if I come in and I take a look at this particular position, it basically, let me give the range a little wider, it basically looked like this. So if it went up above 165, it was going to start to put some pressure on that position. But if it stayed in that 165 area or so, I had a lot of theta decay that I could gain out of this position. And if it were to have pulled back, which it did, I would lose less money than if I had the strict long call. The reason I would lose less money is by selling this 40 call spread, I'm taking in $765 per. Now I'm paying out $420 for this long call in case it blew out the top. So let's call it roughly, I think that's what, roughly $3 times 40. That's about $12,000 in decay that I could have picked up in this trade. And in fact, I did pick that up. I mean, this trade is now essentially fully depreciated, if you will. These are now down to where they're worth about 13 cents, something like that. These are going to be worth next to nothing. So I actually closed this trade out today. I closed out this spread and I'm up 95,000. Again, this thing pulled back significantly from those prior highs, but let's take a look at where I would be if I did not hedge that trade. So if I had not hedged that trade, I would be back here at about $82,000. So by putting on that hedge when the market was back up here in this high range, by adding a hedge to this trade, as the underlying sold off, those call spreads essentially became worthless. And again, I had sold those for whatever that was, $3.50 a piece. I'm now buying them back for a few pennies. So that added to the P&L of this trade. So my game plan going forward is I'll watch Avgo here. My expectation, this looks like a fairly firm, base to potentially rally from again. And if I do start to see that rally coming back into play, I may add a long call or two. But more than that, if we get back up into this 168 range or so, I might look to add a new hedge again at that time. So I just wanted to kind of let people know how that played out. The fact that that did add $12,000 or so to that trade. Another thing I could have done, as I pointed out back when we were up here, I could have just sold my long call at that point and just ended the trade. But I still feel like there's potential in this trade. And I don't necessarily want to take that big profit here in 2024 year as well for tax purposes. And again, everybody's different in that, depends on the type of account you're trading in, etc. So I am not trying to give any tax advice, but for me personally, it made more sense to hang on to it and hedge it than it did to go ahead and lock in those short-term capital gains. So thanks so much, everyone. Please, if you like this content, like, subscribe. If you have any questions, comments, make sure to make them down below. Take care. Have a great weekend, everyone.